What I want to talk about now is what homeowners and buyers need to know about insurance. And I think it's good to start off with a very popular subject, which is assumable policies. So I want to pick
flood
your
insurance.
Yeah, for flood insurance. So I want to start there.
All right.
Pick your brain on that. Tell me about assumable policies and what they are, and let's go.
So this is something that wasn't really a thing before a few years ago. FEMA changed a lot of their rating guidelines. They came out with their new 2.0 system, which has been a lot of fun. Sarcasm. They changed the rates to where there's no more. They're all actuarial rates now. So when you go get a flood policy now, even if you're not in the flood zone, it could be $3,000-$4,000. Or if you're in the flood zone, you could be at $6,000, $7,000, $8,000 very easily. And this isn't just on the beach. This could be in Cape Coral. This could be on the canal. This could be on the river. So a lot has changed with assumable policies. Well, not a lot has changed, but a lot has been brought up about assumable policies. And we get that question all the time with new prospective clients that call us for homeowners. So say somebody calls us for a new home quote, and they always ask about homeowners. Some ask about flood right away, and they say, well, do you know if the current homeowner has a policy now? And that's always something that most time they don't know. So they lean back on you guys, the realtor, to try to help figure out that information. So basically what an assumable policy is if you have a FEMA policy, and FEMA's a standardized product through any company. It could be USAA, it could be Hartford, it could be Allstate, it could be Progressive. There could be 100 different products that say a name of a company, but if it's NFIP, which is National Flood Insurance Program, it's a FEMA policy, and therefore it is assumable, meaning that new person that's buying the house can assume that policy one of several ways. So assumable, a lot of times people think the common way that we used to do is you basically take it over, you transfer it, which is like the only policy you can transfer. Most times ownership changes. You can't just take over that policy, whether it's your son, your brother, a complete stranger. You can't just take over, it has to be rewritten. Well, with FEMA flood, you could. But there's a couple ways to do it though. So I'm sure you've probably seen this with some of your clients being a hot question, right?
Mm-hmm.
So assuming it as a transfer is one of the easier ways and one of the common ways we see it a lot of times. That's basically where the new buyer takes over the flood policy at the current rate, which is a lot of times a lot cheaper than the brand new policy, but that has to be transferred and it has to be accounted for during the closing there because that policy never cancels. The money that was gone into that policy, say it was a $2,000 premium, if that seller transfers that policy, they don't get a refund. And then they call us in a few weeks and say, hey, how come I never got a refund? And it's happened, probably more than you imagine. It happens a lot because it's something that wasn't really common until a couple of years ago.